Thank you, Alex, and thank you all for staying to the last presentation today. So we've been here all day hearing about ICOs and crypto, and I thought this would be a good opportunity to talk about how did we get here. A lot of people entered the space, I think, last year during 2017. Obviously, we had a big hype around ICOs, and we've heard a lot of ICOs today, but I just wanted to give you a bit of background of how do we get here with 1,500 different crypto assets that we have today, and then trying to make a stab at how do we value these things. So it all started with Bitcoin, as you know. Satoshi released the Bitcoin white paper on October 31st, 2008, but it did not come out of nowhere. So I think this is an important point. It was based on decades of research beforehand. So Ralph Merkle invented the Merkle trees in the 80s. That's the data structure used in Bitcoin. Distributed timestamps was developed in the 90s. That's what the miners used to determine what transactions are coming first in the blockchain. And in the 90s, there were a lot of excitement around digital cash. So we had people like David Chaum developing DigiCash, for example. We had Liberty Dollar backed by gold and silver. It was shut down by the FBI. All these systems were centralized, and the libertarians at the time, the people like Nick Szabo, they wanted to create something that was decentralized, not controlled by a single entity. In '98, Nick Szabo released BitGold, similar to Bitcoin. Vaidai had his B-Money, it's referenced in Satoshi's white paper. We had people like Adam Back, still active in the Bitcoin Core community, developing Hashcash that is used for proof of work in Bitcoin. Bitcoin's innovation was based on all these technologies, and I think the genius of Satoshi was to bring these technologies together and create a system where the incentives are perfectly aligned between the different actors in the ecosystem to grow something from nothing to $150 billion where it is today. And there was a true breakthrough in computer science. Before Bitcoin, we couldn't take ownership of a digital asset, and that is the fundamental breakthrough in Bitcoin. And for the first time in humanity, code became money with Bitcoin, and code is just another form of free speech, if you like, and free speech is a fundamental human right. So code becomes speech, becomes money. We can put equal signs between all those things. There are three, I think, parts of blockchain that really puts it apart from other technologies, and that's the permissionless nature of blockchains. So anyone can join these networks, anyone can mine, anyone can transfer value peer-to-peer without a trusted third party. The other part is the censorship resistant. So there are no accounts that can be shut down. Everything is created in a decentralized way. And the third thing is the trust minimizing part of blockchain. We don't have to trust a third party. We can transfer value to anyone in the world, and we don't have to know that person. We don't have to trust that person, but we know that the transaction will happen as it is created. When we look at crypto assets at Apollo Capital, the crypto fund that I co-founded, we look at this kind of characteristics for projects that we invest in. Do they need permissionless? Do they need censorship-resistant characteristics or trust minimizing characteristics? But I think an important point is there are trade-offs with this technology. So blockchain is much slower and costlier than doing something in a centralized way on a central server. And I think that's partly misunderstood. So doing something that is recorded on thousands of computers in a global network costs something. And the price for that is efficiency and the speed of the network. but in return, we get something that we think are much more valuable, and that is the security and the social scalability. So the trade-off, you can say, is between computational scalability and social scalability. All of a sudden, we can trade and do business with anyone in the world, and we don't have to trust a third party. The next big breakthrough was Ethereum. It was announced by Vitalik Buterin in 2013. He was 19 years old at the time. It was launched in 2015, and it quickly attracted a lot of money. So the DAO raised $150 million in 2016 when the network was only a year old. And what Ethereum does is create a system on a global world computer for smart contracts. So smart contracts is snippets of code that are executed on a distributed computer in the Ethereum virtual machine. This quote from Nick Szabo describes a potential early application of smart contracts. Financial derivatives are very well defined contracts, and there's a potential use case for smart contracts, and has the potential to disintermediate big financial organizations. Nick Szabo, by the way, he invented the term smart contract 25 years ago, long before Bitcoin and Ethereum. And Ethereum also led to an explosion of tokens. I mentioned earlier there are 1,500 or maybe even 2,000 different crypto assets traded today, and that is because the innovation that are based on Ethereum. So in the early days, we had blockchain that was based on Bitcoin's code, but on a new chain. That's something like Litecoin, for example. So you needed that new infrastructure of miners and full nodes for these kind of new crypto assets. Then we have other type of crypto assets as well. We have those with a completely new code base, like Ethereum, for example. And I think the final new kind of blockchains are based on a forked chain and a forked code as well. So example of that is Bitcoin Cash, when the complete history is forked into a new crypto assets. But what Ethereum created was a standard to create a new token called ERC20, and that led to an explosion of the number of tokens. So today we have hundreds of tokens based on top of Ethereum, for example. So it makes it really easy. You can create a new token in minutes, and we have things like basic attention token, Civic, we have Omisigo, for example, on top of Ethereum. Those are all ERC20 tokens created on top of another network. So it uses the security model of Ethereum. You no longer had to create a new crypto assets from scratch. And today we have a diversity of crypto assets. We have things like commodity-like crypto assets. That's Bitcoin. We have things like medium and exchange. That's Litecoin and Nano, for example. We have utility tokens, Binance coins, basic attention token, Filecoin, for example. We have tokenized securities. And that's a big potential market for crypto. Maybe one day we will trade today liquid instruments like equities, like commodities, like bonds, etc. On these tokens, and also illiquid instruments like real estate, like VC funds, for example, can be tokenized one day. And the SEC chairman recently said that all ICOs are securities. So maybe there are a lot of securities out there. Maybe Ripple is a security as well. They have a for-profit organization, enterprise behind it. We don't know right now, but hopefully we will get more regulatory certainty later this year what constitutes a security. But when we talk about tokenized securities, we can use traditional DCF cash flow model to value these things. And then the final, I think, kind of crypto asset is the basically the digital collectibles like CryptoKitties, for example. And actually, Andreessen Horowitz, one of the biggest VC firms in the world, recently bought out the team behind CryptoKitties for $12 million. So how do we value these things? Well, if you think Bitcoin is a type of digital gold, we know how big the gold market is. So the value of all gold is between $8 and $10 trillion. We know how many Bitcoins there will ever be, 21 million. We could argue that Bitcoin is better than gold. You can transfer it to anyone in the world instantly for free. It cannot be taken away from you, and it's scarce like gold. If Bitcoin were to reach 10% of the value of gold, one Bitcoin would be worth some $50,000. So that's a simple way of thinking about a digital commodity. Maybe that's one of the properties of Bitcoin, for example. Another way to look at it is what we call the NVT ratio. It's been called the PE ratio for crypto assets. So what is the NVT ratio? NVT stands for network value, so the price of the coin times the number of coins outstanding. And the T is the transaction value, so the on-chain transactions on that blockchain in US dollar for the coin. So network value divided by the on-chain transactions that give you a relationship between the value of the network and the actual usage of the network. This chart here represents Bitcoin. The red line is the NVT ratio the last few months for Bitcoin. We can see it dip down in August of last year, and another bottom in November, I think, of 2017. Both times was before big run-ups in the price of Bitcoin. However, I think it might make more sense to look at these within a certain sector or vertical. Here we are looking at the NVT ratio for the vertical that we can call currencies, Bitcoin Cash compared to Litecoin and Bitcoin. Bitcoin Cash here had a very high NVT ratio earlier this year. So you could argue maybe Bitcoin Cash was overvalued earlier in the year. That would be the conclusion from something like this. We have more general models as well, and I think there are a lot of unanswered questions when it comes to this kind of analysis still. So these are some of the questions that we can ask ourselves. In Bitcoin, for example, we don't know what is the actual transaction and what is the change transaction. We can make good estimates of that, but that's all we can do. What kind of inflation adjustments should we make to these coins? We know the issuance, but should we use the 5-year out or the 10-year out? If this kind of analysis becomes very popular, we will probably see fake volume to try to fake the NVT ratio. I wouldn't be surprised. Privacy coins is another problem as well. Those uses shielded transactions, and we cannot calculate the NVT ratio because we don't know the on-chain transaction volumes for those coins. Then we have off-chain transactions like Lightning Network for Bitcoin, Plasma for Ethereum. What does that mean for the NVT ratio if transactions move to another layer? And then the question is, of course, the on-chain transactions. What is speculation versus real usage? So maybe 1/3 of the transactions for some coins are between exchanges. Should we calculate those or not when we calculate the NVT ratio? So a lot of unanswered questions still doing this kind of analysis. A more general network would be to use something like the equation of exchange. That is M times V equals P times Q. That is basically you take the size of the asset base times the velocity equals the price times the quantity. For an economy like Australia, P times Q would be the GDP. The GDP for Australia is around $1.7 trillion. The M1 monetary base for Australia is $350 billion. And the velocity for M1 is around 5 times. So this is a macroeconomic equation, and we can try to use that for utility and currency, cryptocurrencies as well. And in that case, we would solve for M, which is the monetary base for the crypto assets. So the monetary base would be the price of the cryptocurrency times the number of tokens. And P times Q would be the amount we would like to transfer on that blockchain. And let's do an example. So I take the example of a very simple utility token. There are some very popular utility tokens like Binance Coin and Qcoin that is used to pay fees for in the exchanges. So that's what we call an exchange token. We have to make a number of assumptions. In this example, we have 100 million tokens. We know the global exchange volume at $5.5 trillion. We have assumed that the average commission size is 20 basis points, and using the token you can get a 50% discount. That means the addressable market for a token like this is $5.5 billion. We have to make an assumption about the market share. Let's say 10% in 5 years, a velocity of 10, and we have to discount this. I've used a high discount rate here of 40%. So if we plug into the value of exchange equation, remember we are solving for M. The 10 basis points commission rate equals a P times Q of 550 million. With a velocity of 10, that means we need to transact $55 million on this blockchain. 100 million tokens, that's 55 cents per token. And then we have to discount that back to today's value, which would equal 10 cents per token. So this is the kind of framework to think about the value of some utility tokens. At least it's one suggestion. Of course, there are many unknown. Velocity is a big one. If we assume that people buy the token for speculation, those tokens might not be moved, and the velocity of those tokens are basically zero, which would reduce the overall velocity. So if you have 50% hodlers, for example, that could reduce the velocity in this example to 5, and the token value would thus increase to 20 cents per token. So this is still very early days in type of crypto asset valuation, but with the value of exchange equation, velocity is a bad thing, and hodlers are a good thing. That's still very debatable. You can argue that blockchains want to encourage velocity because it increases the utility of the blockchain. So velocity in that sense would be a good thing. So I think this illustrates that it's still very early days in terms of in doing fundamental analysis of crypto assets. And I think I'll end with a quote from Chris Bruninsky, who has done a lot of research in this area. It's basically very early days, and we are still looking for the best methods. But this is a new area, and we probably can't use the old kind of valuation frameworks. We need to develop new frameworks for crypto assets, and we are doing some interesting work in that area. So thank you for today.